You are listening to Off the Shelf, a podcast by The Conference Board.
Hello, my name is John Metselaar. It's a pleasure to welcome you to this edition of Off the Shelf, a book discussion series brought to you by The Conference Board. Today I'll be sitting down with Dan Toma to discuss his latest book, his very recent book, just out in Asia and Europe and shortly to be out in the US, Innovation Accounting, a practical guide for measuring your innovation ecosystem performance. And this is Dan's second book, and it follows The Corporate Startup, which is developing in a bit of a classic, which takes a higher level at the innovation game. Innovation accounting obviously goes straight into how do you account for innovation in a corporation. And so, Dan, welcome to our show here. It's a thrill to have you. You must be very busy, doing the pitches and the book conversations. So thank you for taking the time out and spending half an hour with us. Much appreciated. And maybe you want to introduce yourself a bit more extensively than what I just rattled off.
John, thank you very much for having me. It's an honor to be on the podcast. Yes, I co-authored indeed the corporate startup and now the newly launched innovation accounting. My background is actually in entrepreneurship. I founded my first company 150 years ago, I would say, when
feels like
exactly, totally feels like it. And then more by chance than by design, I got headhunted by a large telecommunication company. That's when I got started on corporate innovation. That's when I realized the fact that large organizations are very bad at building new products, in particular digital products, because they are just not set up in a way which allows for agility, in a way in which it allows for fast development cycles and customer centricity. And I've been spending probably my past 10, 15 years helping large organizations transform together with my colleagues at the consultancy company Outcome. All of our work goes usually into the things that we've put out in terms of articles and in terms of books, podcasts, or any other content.
Now, it's not common to see the word innovation and accounting in one sentence being used. And I'm sure no better person than you to go and peel the onion, explain how they work together, explain why they're necessary together, why they're complementary, and how you go about that to implement that in a corporation. So give us the starting point of how does innovation and innovation and accounting come together?
Sure. The idea, and when you're listening to this podcast, when you're reading the book, remember one thing: we're not proposing innovation accounting to replace standard accounting or financial accounting. They are both needed. However, we have to be honest with ourselves. We have to be honest with the fact that financial accounting is just a terrible tool for measuring innovation. Is a terrible tool to measure the progress a team is making towards success in the light of that team not being able to account for anything financially. Remember, you launched your idea today, or you are in charge of a program that has 10, 20, 100 ideas that just launched in the past month. However, you are faced with a conundrum. How do I present it to upper management, or how do I present to my manager the fact that I am making progress? Financial accounting is terrible at doing that. Why? Because financial accounting focuses solely on looking at success through the lens of finance, of money, of a transaction. And early on, you might not have that. Early on, you might have stuff that is probably a bit different than money, that still shows that you are on the right track to progress. And that's usually learnings. That's usually how fast you're learning. What are you learning? Are you moving fast enough as a team? Are the teams in your portfolio moving fast enough? Is there going to be a bucket of gold waiting on you at the end of the rainbow? Or are you just burning cash? So again, the idea of innovation accounting is not to replace financial accounting, but to complement it in presenting some indicators that are super useful early on. Once your program, once your idea passes through a certain maturity threshold, then financial accounting kicks in. Then it's going to be valuable. Imagine you would be an early investor in Tesla. Would you measure Tesla's potential for success by looking at how many factories they have, as the way you would measure Daimler or Volkswagen or Toyota. No, probably you're going to look at other things. How fast they're learning. Are their products visionary enough? Is there a charismatic CEO? They're totally different indicators than you would use when you measure the performance of Daimler.
It's the increasing importance of the intangibles over the tangibles, right?
100%. 100%.
We're seeing that happening all around, and I guess in the sense that when it comes to measuring innovation, you're damned if you do, you're damned if you don't. If you do, and you do it with the conventional CFO metrics, you end up with killing everything. If you don't, you end up with a mess. And this is unfortunately the last part. Is unfortunately where many companies still are. Right? They equate innovation with post-it hackathons, table tennis, and all sorts of other tools.
If I may quickly, just to give a metaphor to people, so we keep this conversation super practical. Imagine the following: if you're listening in and you have kids, let's say they're swimmers or runners, right? They're signed up to the swimming club. Would you measure their performance for 50 meters freestyle against the time an Olympic athlete just had at the Olympics this summer at Tokyo? Probably not, because if you do that, you're going to be highly disappointed by the performance of your 10-year-old, 5-year-old, or 12-year-old. This is why they compete against other 5-year-olds, and there is a benchmark for their performance in their age group. Much in the same way, innovation or innovative ideas, they need to compete against other innovative ideas, and they have to have their own benchmarks for performance. Otherwise, if you're just going to compare a product that was launched last week, with a product that has been in the market for, let's say, 10 years, 15 years, or in some cases even 100 years, you'll be highly disappointed by their performance. It's a matter of changing the lens through which you look in order for you to understand if that particular product is going to be successful or not. And that's exactly what innovation accounting is doing.
So you need to account, but you need to do it properly.
Exactly.
And you need to do it in the appropriate context of your child, in your case, or obviously in the corporation when we look at the business world. Now, innovation accounting, I love your definition, which I'm just going to summarize, which is an organized system of principles and indicators designed to gather, classify, analyze, and report data about a company's breakthrough and disruptive innovation efforts, working to complement the existing financial accounting system. So with that definition grounded, I hope the listeners, let me read it again. An organized system of principles and indicators designed to gather, classify, analyze, and report data about a company's breakthrough and disruptive innovation efforts. And it's working to complement the existing financial accounting system. So how do you go and organize for this? What elements do you need to include?
Yeah, so first of all, we need to understand that innovation accounting is not just one indicator. It's actually a series of indicators that are interconnected and mutually self-supportive. And these indicators need to work across the organization. So you're going to have indicators that have to do with the performance of individual teams or an individual team. Then you're going to aggregate that to the performance of your entire innovation funnel or your innovation pipeline. And then you are going to have another layer of indicators sitting over the very top that have to do with the performance of your overall investment in innovation, internal and external. And that's looking at portfolio, that's looking at the actual financial outcome if you are in a for-profit organization. And then you have indicators that have to do with culture and capability. So essentially the things that support innovation, the things that support innovative activities from happening.
Now, you cannot only look at results, right?
Yeah.
Because results are something you do after the fact, but an innovation process can take, depending on your industry, 3 to 5 to 10, or you look at Airbus, even 20 years.
If you just look at results, you are essentially telling to everyone that you don't understand how value is created in your organization. If you're just
so you need to look at performance
exactly.
As well, right? So you want to say a few more on how do you take in perform, and maybe go level by level. So maybe start at teams and illustrate how performance and results are both important.
So at every single layer, you will have to look at both performance indicators and result indicators. And if we start from the bottom at team level, you'll have performance indicators that usually revolve around the learning velocity we just mentioned. How fast are you learning? But obviously, the performance indicators are not only limited to learning velocity, but these performance indicators have to be correlated with two things: the business model that the particular team is working on, but also with the maturity that the idea is at. Ideas that have launched yesterday, obviously, you're going to be probably very interested in their learning velocity. Ideas that have been in the market for 3 months, you might be a bit more interested in their profitability or their customer acquisition cost or certain retention indicators. So that will be on performance. On result indicators for team, probably one of the most important indicator here is confidence. The confidence decision makers have in individual ventures. This is investment 101. Everybody or anybody that invested in a startup or was part of a startup that was invested in by a VC or by an angel will know that their job is to convince the investors that they are on the right track, to convince the investors that they meet certain criteria to make the next investment round. That's the confidence. That's the confidence, which is obviously the opposite, if you want, of de-risking. The less risk I have in my venture, the more confident an investor would be to invest in me, or a decision maker to invest in me. So
I love those two
that's the
points that you
outcome.
highlighted.
That's the
Yeah.
outcome of the activity. I'm performing experiments. Why am I performing experiments? Because I want to convince a decision maker that my venture is worth investing in. I'm performing experiments because I want to de-risk my venture. How do I do that? Well, there's an entire methodology on how to run experiments.
So on performance, it's about learning. How do you drive that learning? How do you create what I call a love of learning culture? And how do you progress? It's so important in this world where things develop so fast. If you fall behind on learning, you fall behind on everything. And then indeed, confidence and managing risk, minimizing risk, excellent points when it comes to results.
Exactly. And as you move up
How,
now at funnel, you are aggregating data from multiple teams, and then you're looking at certain time it took or it takes on average teams to reach a certain development stage in the product lifecycle, a certain conversion rate from one stage to the other, how many ideas we killed in stage one or in stage two or in stage five. So you're essentially aggregating data from all the teams. You're aggregating data from all the investments you're making, and then you will have some indicators around the performance of the funnel. Usually, these indicators are very much connected to cost and time and survivability of ideas. And if you move one layer up, which is the layer of strategy, the layer of the overall investment in innovation, then the things get really exciting because you are combining financial results, again, financial accounting results, with what's happening in innovation. So you're going to have indicators there such as NPVI, New Product Vitality Index, which shows percentage of today's revenue coming from products you launched in the past 3 or 5 years. You're going to have their efficiency of innovation investment. So from that NPVI figure, how much have we spent for every new dollar of revenue coming in the organization? And you'll have a bunch of other great result indicators that are going to show you if the investment that you are making in innovation and the performance of the innovation system is actually on par with what you need or what you expect it to be, or what your organization needs it to be.
so you covered team level, you covered the level up, which is the manager level, if you
Yeah,
want. How do you manage innovation? And then the last, you can argue, is the leadership level, right? This is where the C-suite typically gets involved, or at least the very senior
exactly.
management. And so, what I like about your book, by the way, is that you don't stop there, but you also recognize that all this can only happen if you establish a fertile ground of culture and capability. So, you want to speak a bit to how important that is and how you approach that?
Culture is very important, and the problem with culture, I would say, is the fact that the way my organization is set up, or the culture I want to have in my organization, is different from the culture of your organization and what you are expecting from culture within your organization. The way to measure culture revolves more around having the right process of measuring culture rather than some very prescriptive slash dogmatic indicators. The process is the following: you have to start with what do you want to get, what is the thing, what is the result you want to influence, and how does culture play into that result, what is the cultural impact of that particular result, how is it connected. Let's say, for example, we want to generate more transformational ideas. Well, there is definitely a cultural component to that, and that cultural component is, for example, psychological safety or nonconformity or middle managers allowing for people to speak up their mind. um, all these essentially are cultural traits. What you can do then, after you define the cultural traits that influence or impact that particular outcome that you're looking for, you can measure that. You can measure that for surveys. You can measure that for interviews. You can come up with other measures. Measure that. See if those traits exist and to what extent do they exist in your organization, and then try to influence those particular traits. I don't know. You do a training program, you put people through a certain program, you send people off to a certain school to learn about, let's say, psychological safety, so on and so forth. After that, obviously you can measure if people actually do it, right? If people join that program, if people complete homework, or if they join a certain activity. And after that, you have to measure again the outcome from which you actually started this entire exercise. And if that outcome hasn't changed, probably it means that you either selected the wrong cultural attributes, or there was an issue in the deployment of the training designed to influence that particular attribute. However, if you do things right, you will see that particular outcome being changed towards what you want it to be.
And please don't take the excuse that you cannot measure culture.
Yes,
Yes, you can measure
you can
culture.
measure culture. Yes, indeed, indeed,
You
culture can be measured.
just need to look at it beyond the tip of your nose. There's plenty of tools there. Um, how do you bring that all together then, Dan?
Well, you have
Those four levels.
you have to have a system, and every single time you create an indicator or you think about putting an indicator in place, it's encourageable to look at what are the things that connect to that particular indicator. As I said, innovation accounting system is something very intimate, if you want, to every organization. Every organization needs to have their own innovation accounting system. Yes, there might be similarities between company A and company B or companies within the same industry, but essentially, you will have to look at the principles of creating an innovation accounting system before you build your own. And yes, in the book we talk about 6 principles. I would like to highlight only a handful of them, just probably 2 or 3, because I find that to be the most important ones. First of all, the system needs to be company wide. You can't have innovation accounting system for department A and a totally different innovation accounting system for department B or geography X. If you agree as an organization that a certain thing is important for you innovation wise, then that particular thing needs to be lived and breathed by everybody around the organization. So the innovation accounting system needs to be company wide. Then it's important whenever you design an innovation accounting system to keep in mind 2 things. It needs to highlight the risk of disruption that the company is under, and it needs to help you improve the innovation system. If the innovation accounting system you design doesn't do either of the two, you probably need to redesign the system. And another thing I want to highlight, again, I probably mentioned it earlier, the indicators that are part of the system need to be mutually self-supportive, and they need to flow nicely from one to the other, because otherwise you're just going to have individual indicators not connecting with anything. Then you're going to ask yourself, why do I even bother measuring those? So again, there's 6 principles. However, this 4 that we talked about are probably the most important ones.
And so the one that I think is so critical to reinforce is the fact that indeed you need to have actionable systems in place at each level, right? At the teams level, at the management level, and at the leadership level, supported by the people level, the culture level. but then it needs to flow from one into one another, so that at every level you have a dashboard that is tailored for your specific needs. And I think this is actually, I find, a really difficult podcast. By the way, we did a webcast as well with Dan, where you see a few slides, because there's some really great illustrations to go and make things more tangible when you can either watch the webcast, go to the conference boards on demand, or actually go and buy the book, and use that as a complementary resource and really dig into it. So that point I wanted to highlight. Then if there's I'm in the leadership, I'm a CEO of a small company. I have about make this up 2,000 people in my corporation, and I've seen the light that I need to go and innovate to create value into the future. Where do I start? What would you say?
Well, first of all, you will have to establish an innovation process. If you don't have yet an innovation process, that's your starting point. And by innovation process, I don't only mean the process itself, but the entire governance around innovation. So you have to have a product lifecycle in place. You will have to have people trained and appointed to take decisions with respect to innovation. And obviously, the most important thing is that you will have to have people actually doing innovation, meaning that there is innovation happening in the organization. It's important to do innovation if you want to measure innovation, right? It's pretty trivial. And then from there, you can talk about how do we put an innovation accounting system in place? What will be the first indicators that you would have to have, and how do you expand from there as your maturity increases?
So thank you for that very actionable advice. I want to let you summarize, or I want to I want to let you make a key point at the end of our conversation.
Yeah, I think the most important takeaway would be that, or two takeaways here. Innovation accounting is not here to replace financial accounting. This was never our scope. This was never our goal. However, we want to help innovators and top leaders, in particular CFOs, play a more active role in innovation. We wanted to create a language that is going to encourage a meaningful conversation between an innovator coming into the office in flip-flops and a CFO coming in the office in a suit and a tie. And innovation accounting should be that common ground where they both come together and they speak the same language in a meaningful way that's respectful of each other's background and activity. At the end of the day, both of them are on the same side, fighting the same battle. They are both aiming the greater good of the organization. And the last thing is that innovation accounting can only happen if you do innovation. If you have absolutely no innovation activity in your organization, don't bother implementing an innovation accounting system. Don't bother buying a software that's going to help you measure innovation, because hey, guess what, there's no innovation happening in your organization.
Now, if you are in option B, then I will go and change, because the only constant in today's VUCA and storage world is change. And if we don't go and get ourselves with the change, or if you want to succeed and thrive ahead of the change, then you better start to innovate. And back to change, we, as you rightly said in one of your slides here, we change what we measure. So let's measure what we value. And that's I find that to be very important. Change is indispensable today. We change what we measure, and so make sure we measure what we value. And so that leads you to produce new value into the future of your corporation, and make sure that you have a sustainable business. So Dan, thank you very much for an excellent summary and an excellent presentation of illustrating the need to go and find the sweet spot of measuring innovation and accounting for innovation that is in between, doing nothing and creating a mess, or not even starting, and suffocating innovation because you put your conventional accounting metrics onto your innovation efforts. That was awesome. Thank you. With that, thank you all for listening. I hope you found this valuable. If you enjoyed this episode, please remember to subscribe to our off-the-shelf book discussion podcast series, or explore the entire catalog of podcast programming from the Conference Board by visiting our website at tcb.org/podcasts. And again, Dan, thanks so much, and I'm looking forward to collaborate, partner, and learn together.
My pleasure.
Thank you very much.
Thank you.
This has been Off the Shelf, a podcast by the Conference Board.